So this month, rather than a traditional get-together, I decided to do a multi-part series on estate planning. So in the first video, we talked about the key documents needed in an estate plan. The second video, we talked about the broad differences with trust structures. My last video, I talked about gifting within the family, and this one I'm talking about charitable strategies. And charitable strategies I'm breaking into two parts: lifetime giving and giving upon your passing. I'm Katie Brown. I'm a certified financial planner, and I have had the privilege of serving families for nearly 20 years figure out their financial journey. So the benefits of lifetime giving are that you can hopefully witness the impact of your gifts and enjoy that, and then also remove some assets from your estate and remove the future growth of those assets in your estate. So a couple of things you might want to consider for lifetime gifts. You can gift outright to a charity if you want to. Other ways that you can gift directly from your retirement, from your IRA, if you're over age 70 and a half. And when you do that, then whatever amount you gift from the IRA directly to the charity does not show up as taxable income on your taxes. Otherwise, say you take a $10,000 distribution from your IRA, then you have $10,000 show up as income on your taxes. In this case, that doesn't happen, so you get the full benefit of the gift. So that's one thought. Another thought is gifting appreciated stock. So let's say you have some stock, maybe that was gifted to you when you were younger, and it has a really low cost basis, and if you were to sell it, you would have significant tax implications. But it might be at a spot where it's becoming challenging to manage the portfolio around it. And so you could consider gifting appreciated stock to a charity of your choice. So that's another great option. Or you might want to take advantage of a donor advised fund. And this actually couples really well with appreciated stock, because you could gift a large stock position into a donor advised fund. And the benefit of a donor advised fund is that you're removing those assets out of your estate, but you don't necessarily have to send them to the end beneficiary right away. So you could spread out the distribution. So if you had $100,000 of appreciated stock that you wanted to gift to a donor advised fund, then from that fund, you could gift that out over several years. So maybe you want to send $5,000 to this charity and $5,000 to that charity, and the following year something different, the following year something different. And it just gives you a lot of flexibility around that. Donor advised funds are also great to couple with an income windfall. So if you have a large bonus from work, for instance, or maybe you sold a business, to establish a donor advised fund and gift to that in that year really helps to offset that income. So a couple of thoughts there. And then I just wanted to touch on a couple of charitable trusts that we see as well. There's charitable lead trusts and charitable remainder trusts. A charitable lead trust, just kind of high level, I'm not going to get into the weeds here, but a charitable lead trust is where you can gift a piece of property or asset into the trust, and you name a beneficiary, charitable beneficiary. That charity will receive income throughout the term of the trust, and then when that term is done, that piece of property flows back to you or back to your heirs, but you get gift tax deductions along the way. A charitable remainder trust is pretty much the opposite. So you can gift property into a charitable remainder trust, and the income can flow back to you or another heir, but then that property at the end of the term flows to the charity. So a couple of different vehicles that you could use there. And then gifting upon your passing. So you could name a charitable organization, you could have a specific bequest to them inside of your will if you wanted to do that. Or we often see charities named as beneficiaries of a retirement account or a life insurance policy. You know, life insurance is a great way to leverage a gift to an organization that you want to support. Or, as I mentioned, on a retirement account, depending on your financial situation, perhaps you don't want to gift all of that away now, but you want to make sure they receive something later. The Secure Act of 2019 changed the distribution schedule for inherited IRAs. So now, if a non-spouse inherits an IRA, they have to distribute that entire account within 10 years. And so it could create a lot of tax implications. So if you have money that you want to go to heirs and money that you want to go to charity, you may want to consider naming the charity as a beneficiary on the IRA, and then the other individuals as beneficiaries are flowing through the will of the non-IRA accounts. I hope this has been helpful. I am including a download if you would like to check this out on charitable giving, so please feel free to grab that. And once again, if you want to reach out to me, you can at kbrown@mortonbrownfw.com. Take care.